Captives are special type of insurance company set up by a parent company, trade association, or group of companies to insure the risk of its owner or owners and risk retention groups in which entities in a common industry join together to provide members with liability insurance where the first mechanisms to appear. Other options, including risk retention pools and large deductible plans, are forms of self-insurance followed. Are products such as catastrophe bonds, weather derivatives, and micro insurance programs are also emerging as an alternative to traditional insurance and reinsurance products. Alternative market mechanisms. Point number one, captives. Wholly owned captives are companies set up by large corporations to finance or administer their risk financing needs. If such a captive insures only the risk of its parent or subsidiaries, it is called a pure captive. Captives may be established or to provide insurance to more than one entity, an association or group of companies may band together to form a captive to provide insurance coverage. Professional doctors, lawyers, accountants have formed many captives over the years. Captive may in turn use a variety of reinsurance mechanisms or to provide the coverage. In particular, many offshore captive use a fronting insurer to provide the basic insurance policy. Fronting typically means that underwriting claims and administrative functions are handled in the United States by an experienced commercial insurance company. Since a captive generally will not want to be involved directly in running the insurance operation, also fronting allows a company to show it has an insurance policy with a US licensed insurance company, which it may need to do for legal and business reasons. The rent-a-captive concept was introduced in Bermuda 20 years ago and remains a popular alternative market mechanism. Rent-a-captive serve businesses that are unable to capitalize a captive but are willing to assume a portion of their own risk and share in the underwriting profits and investment income, generally sponsored by insurers or reinsurers, which essentially rent out their capital for a fee. The mechanism allows users to obtain some of the advantages of a captive without having the expense of setting up a single parent captive and meeting minimum capital and surplus requirements. Captive have been expanding into the employees benefit arena since 2003. The year in which the Department of Labor gave final approval to Archer Daniels Midland CO plan to use its Vermont captive to reinsure group life insurance benefits. while the leading domicile for captives in the US is Vermont offshore captive coverage. US risks are predominantly located in Bermuda, where they enjoy tax advantages and relative freedom from regulation. The Cayman Island, Jersey, the British Virgin Island, Luxembourg, and Barbados are also significant centers for captive. Vermont is the leading domicile for captive in the United States. Point number two, self-insurance. Self-insurance can be undertaken by single companies wishing to retain risk or by entities in similar industries or geographic locations that pool resources to insure each other's risk. The use of higher relation deductible is increasing in most lines of insurance. In workers' compensation, many companies are opting to retain a larger portion of their exposure through policies with large deductible amount of 1 lakh dollar or higher. Large deductible programs, which were first introduced in 1989, now account for a sizable portion of the market. Point number three, risk retention groups. A risk retention group (RRG) is a corporation owned and operated by its members. It must be chartered and licensed as a liability insurance company under the laws of at least one state. The groups can then write insurance in all other states. It need not obtain a license in a state other than its chartering states. Point number four, risk purchasing groups. Like risk retention groups (RRGs), purchasing groups must be made up to persons or entities with like exposures and in a common business. However, whereas RRG are liability insurance companies owned by their members. Purchasing groups purchase liability coverage for their members from admitted insures surplus lines carries or RRG. Laws in some states prohibit insurance from giving groups form to purchase insurance advantages over individuals. However, purchasing groups are not subject to so-called fictitious groups laws, which require a group to have been in existence for a certain period of time or required a group to have a certain minimum number of members. The Risk Retention Act of 1986 specially provided for purchasing groups to be created to purchase liability insurance for members of the sponsoring groups. V catastrophe bonds. Point number five, catastrophe bonds and other alternative risk transfer ART products. A number of alternative risk transfer ART products such as insurance-linked security and weather derivatives have developed to meet the financial risk transfer needs for business. One such product, catastrophe bonds, risk-based securities sold via the capital markets, developed in the wake of the hurricanes Andrew and Inky in 1992 and the Norwich earthquake in 1994. Mega catastrophe that result in a global shortage of reinsurance for such disasters. Tapping into the markets allows insurance to diversify their risk and expand the amount of insurance available in catastrophe prone areas. Zurich Financial Company was the first major catastrophe bond to be triggered. The 190 million bond was triggered by 2005 Hurricane Katrina and result in a total loss. Principal catastrophe bonds are now on multi-billion dollar industry.